Gold closed above $5,000 on the weekly chart for the first time in human history. Russia's central bank publicly rejected any return to the dollar system, despite Bloomberg's fabricated headline that crashed markets Thursday. China just announced enforcement actions that could shatter the Western precious metals cartel within months. Meanwhile, the U.S. Treasury faces $9.6 trillion in debt maturities over the next 12 months, the largest refinancing event in American history, and almost nobody is paying attention. OG John the 20th here. Quick reality check before we go further. If you came here looking for hopium or reassurance that everything's fine, you're in the wrong place. If you want someone to tell you your dollars are safe and the system works, CNBC's still free. But if you're ready to see what's actually happening backed by verifiable data, court documents, and historical precedent, you're exactly where you need to be. Still watching? Good. Drop a comment saying OG John the 20th if you're locked in and ready to see how deep this goes. Current prices as I'm recording this. Silver Western Spot trading $77, futures holding $77, Shanghai Spot $86, Shanghai Futures $88. That's a $9 premium holding steady. Gold Western Spot $5,040. And as of Friday's close, gold officially printed its first ever weekly candle close above $5,000. Not an intraday spike, not a flash wick that got sold. The weekly candle closed at a level we have never seen in the history of markets. Go check COMEX data yourself. Shanghai data is publicly posted. Everything I'm telling you is continuously verifiable in real time. Now let's address the Bloomberg situation directly because this matters. Bloomberg published a headline yesterday claiming Russia was considering a return to the US dollar system. The headline sparked massive volatility. Gold dumped. Silver got hammered. Momentum reversed instantly on what looked like major geopolitical shift. Except there's one problem. Russian central bank chief Elvira Nabiullina came out publicly and confirmed zero involvement in any such talks. None. The entire narrative was fabricated. When a central bank governor has to publicly deny participating in negotiations that supposedly happened, that's not journalism. That's market manipulation through coordinated fake news. Bloomberg spoofed the precious metals markets with a completely invented Russia dollar story, and now it's documented. Here's what Russia actually said. They made it crystal clear where their monetary journey is headed, and it's not back to dollar dominance. The whole story was absurd from the beginning. Last video I called the Bloomberg article misleading. Now we have confirmation. Russia is not returning to the dollar. It was a lie. And when the central bank chief has to publicly refute talks that Bloomberg claimed were happening, that's not a misunderstanding. That's deliberate market manipulation disguised as breaking news. But here's the data point that changes the entire game. China just announced new enforcement rules for non-SGE and non-SHFE off-exchange gold and silver trading. 4 critical actions being implemented immediately. First, off-exchange leveraged derivatives will no longer be tolerated. Leveraged paper longs, leveraged paper naked shorts, done. Finished. Second, physical gold and silver deliveries will be enforced across the board. No more cash settlement games where paper gets settled in fiat instead of metal. Third, off-exchange fractional reserve gold and silver operations will be scrutinized and regulated. Fourth, off-exchange gold and silver rehypothecation will not be tolerated moving forward. This breaks the cartel. When China bans rehypothecation and forces physical delivery on all off-exchange trading, that eliminates the paper multiplication mechanism Western banks have used for decades to suppress price discovery. Here's how it works. 1 physical ounce gets rehypothecated 10 times, creating 10 separate paper claims on the same underlying metal. China just said that game is over. Physical delivery enforced. Fractional reserves under scrutiny. Leveraged derivatives banned. SHFE silver inventory sits at just 11 million ounces total, as China heads past Chinese New Year already. Friday they added 126,000 ounces to SHFE vaults, barely enough to stave off immediate default. Nothing more. Silver closed $89.17 on SHFE, showing a $2.31 premium over SGE spot. Gold closed $504. That SHFE premium over SGE reveals internal Chinese arbitrage spreads widening even within their own market structure. When Shanghai futures trade more than $2 over Shanghai Gold Exchange spot, that's physical shortage stress showing up inside China itself, not just East versus West divergence. This is stress within the Chinese system. David Morgan just dropped an absolute bombshell. The silver guru gave an exclusive interview warning the US government will stockpile silver. Not speculation, not theory. Strategic analysis based on geopolitical necessity. Morgan explains why he believes this silver bull market has approximately 1.5 years remaining, during which we'll see the majority of the entire bull market's gains concentrated. 90% of gains compressed into 10% of the time. That's the pattern Morgan's calling based on historical precedent. And when the U.S. government stockpiles silver for strategic reserves, that creates permanent sovereign-level bid that doesn't care about price, only about securing supply before it becomes unavailable. Here's why U.S. government stockpiling makes absolute strategic sense. China produces only 13% of global silver supply, but controls 70% of the world's refined silver infrastructure. Mining isn't the advantage. Processing is everything. Raw silver ore is economically worthless without refinement capability. Refined silver is required for advanced military guidance systems, AI chip manufacturing, high-performance electronics, and energy transition technologies. No processed silver means no AI revolution and no modern warfare capability. The U.S. is desperately attempting to achieve mineral processing independence because China currently dominates global refining infrastructure completely. Now look at gold physical ETF holdings. They have yet to reach 2022 highs. Think about what that means. Gold price in 2022 was $1,900. Gold price right now is $5,040. While gold price increased nearly 3 times, physical ETF holdings sold off continuously. Almost nobody except central banks is actually participating in this gold rally. Retail investors and institutions selling ETF shares while price triples higher. Central banks stacking physical metal while everyone else liquidates paper exposure. We are early, extremely early. When price triples and ETF holdings simultaneously decline, that's not speculative mania. That's fundamental revaluation happening without crowd participation yet. The U.S. government is running one of the largest budget deficits in recorded history right now. First 4 months of fiscal year 2026, the U.S. budget gap reached $697 billion. Third highest deficit ever recorded, running only below last year's record and the 2021 post-crisis emergency response. Government outlays hit $2.5 trillion, while revenues came in at $1.8 trillion. Net interest expense alone rose to $346 billion over 4 months. That's over $1 trillion annualized just in interest payments, up from $322 billion same period in 2025. We're hitting deficit levels usually seen during declared crises before any crisis has been officially acknowledged. And here's where it gets worse. Massive amounts of U.S. debt are coming due immediately. $9.6 trillion of U.S. marketable government debt will mature over the next 12 months, most ever in American history, double the amount that matured before the 2020 crisis. When you have $9.6 trillion maturing within 12 months, while simultaneously running a $697 billion deficit in just 4 months, that's refinancing risk colliding with fiscal crisis in real time. The Treasury has to roll over $9.6 trillion in existing debt and fund new deficits simultaneously. This isn't theoretical. This is mathematical reality. Current pricing. Silver trading $77 Western, $86 Shanghai, $9 premium holding. Gold, $5,040 Western. Shanghai premium on silver expanded from $7 to $9 over just 3 days, while Western paper markets consolidate sideways. SHFE inventory remains at 11 million ounces total, with only 126,000 ounces added Friday. China now enforcing physical delivery, banning rehypothecation completely, scrutinizing fractional reserve operations. U.S. government preparing to stockpile, according to David Morgan's analysis. Central banks stacking aggressively, while ETF holdings decline despite price tripling. Everything's accelerating. Bearish case because intellectual honesty actually matters here. Gold at $5,000 could pull back violently. Parabolic moves correct hard and fast. Silver at $77 hasn't reclaimed $81 resistance on the hourly chart yet. Shanghai closed for holiday creates an 8-day manipulation window that Western banks have historically exploited during Asian market closures. David Morgan's 1.5-year timeline could be completely wrong. U.S. government stockpiling is strategic analysis, not confirmed policy yet. China's off-exchange enforcement rules could be circumvented or delayed significantly in actual implementation. The $9.6 trillion debt maturity could roll smoothly if international demand materializes as expected. Bloomberg's fake news moved markets Thursday, but didn't break anything structurally. Russia denying dollar return doesn't automatically force immediate dollar collapse. ETF holdings declining while price rises could reverse instantly if retail investors pile in aggressively. A $697 billion deficit in 4 months is mathematically unsustainable, but governments have sustained the unsustainable for literal decades before. Markets can remain irrational longer than you can remain solvent. Always. But here's the counter-argument to everything I just said. Bloomberg got caught red-handed fabricating the Russia dollar story. That proves mainstream financial media operates as market manipulation tool, not legitimate news source. Russian central bank chief publicly confirmed no talks happened whatsoever. The lie is now documented publicly. Gold broke $5,000 despite the fake news attempt to crash it. The move held. China banning rehypothecation and enforcing physical delivery eliminates the paper multiplication mechanism that suppressed precious metals prices for decades. SHFE inventory at 11 million ounces is absolutely nothing against Chinese industrial demand and investment demand combined. David Morgan warning about U.S. government silver stockpiling aligns perfectly with strategic reality. China controls 70% of refined silver globally. The U.S. needs processing independence for AI development and military applications immediately. Physical delivery enforcement means the paper games are ending in Chinese markets first, and when China moves, the world follows. The $9.6 trillion debt maturity happening over next 12 months represents unprecedented refinancing risk during an active deficit crisis. This isn't normal. Gold ETF holdings declining while price triples means we're early, before retail and institutional participation even begins. Central banks stacking physical while liquidating paper through ETF redemptions shows the most sophisticated players are accumulating before the crowd recognizes the revaluation happening. U.S. budget deficit hitting third highest ever during supposed economic recovery, not crisis, proves the fiscal situation is terminal. Net interest at $1 trillion annualized means the debt spiral is accelerating, not stabilizing. Russia publicly rejecting the dollar while China simultaneously bans metals rehypothecation, shows the multipolar monetary shift accelerating, despite Western propaganda trying to deny reality. What actually matters right now in this exact moment? Gold just printed its first ever weekly close above $5,000. Period. End of story. That's history being made. Bloomberg got caught fabricating the Russia dollar narrative completely. Central bank chief publicly confirmed zero involvement in talks Bloomberg claimed happened. China dropped the enforcement hammer on rehypothecation, banned leveraged off-exchange derivatives entirely, and is now forcing physical delivery across all markets. No more cash settlement games. No more paper multiplication. SHFE silver inventories sit at 11 million ounces total. Just 126,000 ounces added Friday. Barely enough to avoid default. Nothing beyond that. David Morgan dropped the strategic warning. U.S. government likely to stockpile silver based on geopolitical necessity. His historical analysis calls for 90% of bull market gains clustering into 10% of the total time. We're entering that compression window now. Next 1.5 years could define this entire cycle. Here's the strategic reality the establishment completely ignores. U.S. produces 13% of global silver. China controls 70% of global refining capacity. Mining means absolutely nothing without processing infrastructure. No refined silver means no AI chips, no advanced military guidance systems, no energy transition technology. That's why the U.S. has no choice but to secure physical supply immediately. Price won't matter when availability dries up completely. Gold ETF holdings keep falling while price keeps climbing higher. Only central banks are buying right now. Retail and institutions selling the entire way up. That's not euphoria. That's not speculative mania. That's early-stage fundamental revaluation happening completely under the radar. U.S. deficit hit $697 billion in just 4 months, third largest in history. Net interest alone running at $1 trillion annualized. And over the next 12 months, $9.6 trillion in U.S. debt matures, double what rolled before the 2020 crisis. That's not a refinancing challenge. That's a mathematical trap with no clear exit. Silver premium in Shanghai holds at $9. Western paper still stuck at $77. SHFE at 11 million ounces. China controls 70% of refining. Physical delivery being enforced. Rehypothecation finished. Bloomberg exposed publicly. Russia done with dollar talks permanently. Central banks accumulating aggressively. ETF holders exiting continuously. Gold $5,000 weekly close. First time in history. Invest with logic, not hype. OG out.